Hello and welcome to yet another episode of Outlook 2017, our special series where we are showcasing just a few experts to get their sense of where India comes out in the next year from all the troubles of 2016. It's been a flat year. It's been a disappointing year for equities in 2016. Much of it came towards the end, but it's a year which began badly and is ending badly as well. So what about the next one? My guest today on the show is Krishna Kumar, Investment Director at Eastspring Investments, long-term watcher and a very substantial investor into the Indian market. Krishna, always a pleasure speaking to you, and we speak in tough circumstances for this market, which has had a very pedestrian year. Are you looking into the next year with hope, or do you think it'll be still a tough task, the first half of it, to negotiate through the kind of strife that we are going through?
Yeah, Udayan, it has been a tough year. I mean, the global environment has not been favorable, and everything has been, bobbing around a little bit here and there. Looking into the next year, I'm less hopeful because, things the way they are shaping up, it is not helping either the Indian cause or the way the Indian system is going forward. We've done a few changes. There are a few corrections. There are a few remedial measures which have been taken. But honestly, I think it's going to be a very tough year going into 2017.
Do you think it's only the first part of it, Krishna, which will be challenging as we wade our way out of this demonetization thing? Or do you think even in the middle of the year, once GST starts coming in, that will present some challenges as well to the whole system, which might be another headwind for earnings to recover as we were expecting this year, but which did not happen?
You see, the way I think about this is not about demonetization, GST. These are measures which are constructive. These are measures which are possibly going to have a more substantial benefit over the long term. The moment you say over the long term, you must understand there is something in the short term which we miss. The point that I'm thinking about is when you take a step forward in terms of corruption and you want to address it systemically, the impact is far longer than you can imagine. The only case in point stroke reflection that we have of this nature or size is China, when Premier Xi Jinping took the step of taking corruption or rooting corruption out of the system. He started in 2014, and trust me, it has taken him 3 years. And all these measures take a long time. Now, GST is equally disruptive. And there is going to be a lot of informal businesses which are going to be brought into the formal setup. So when I say disruption, the informal business coming into formal business will render a lot of them out of business. So, you've got to think about these two things when you think about whether it's the first half or second half. Honestly, I'm not very sure whether it's a 3 or a 6 month kind of a window when this corrective phase goes through.
I remember our last discussion when I was talking to you quite many months back, and you were making the point then that if Capex does not pick up, and it hasn't yet, then this market will struggle to move higher, and valuations on hindsight might actually appear quite stretched. And Capex has not only not recovered in 2016, now the prospect of recovery might have got postponed with all that has happened. Does that make you nervous that after 5 years of waiting for Capex, we probably kicked the ball down another year and a half down the road?
Yeah, I remember the conversation. We were hoping that Capex can come in to salvage whatever has been lost. And the Capex, which is very elusive, obviously the private sector is very reticent about Capex and not willing to put the dollar on the ground. The point here, even now, is that the state-owned enterprises still have a lot of cash, and the ball has to be kicked. The ball has to be set rolling by them rather than anybody else. And it is in the realms of reality that this can still happen, and it is not far-fetched. We've seen some semblance of Capex on the ground, but which I don't think is going to be enough, at least for now, to kickstart. There has to be far more serious effort. You have to have that initiative in roads, ports, airports, and a whole lot of them. I have not heard too much, but people keep talking. It's the Indian corporate world which kind of keeps hoping and dreaming that defense budgets will go through the roof and infra projects will kick off. But this normally has a 6-month lead that corporates are given a heads up. And I'm kind of still not seeing it, honestly.
That's the local part. What's the global backdrop, Krishna? From what's the sense you get when you speak to your end investors? Because in the last month or so, it appears that the big boys are running, the US, Japan, and you know, people don't seem to have that much mind space about emerging markets with the way the dollar, the US bonds, and the US equity markets have moved. Do you think we could be overshadowed? I mean, people will not spend enough time looking through the pain in a small market like India when there are gains to be made in their own market?
Yeah, I mean, see, think about it. The dollar trade is a consensus trade. The dollar trade is the safe haven trade, and that's kind of getting completely consumed. And people are, you know, shedding other currencies and moving into currency which is more safer. Is that overdone? I wouldn't know. But the important point which I keep hearing from investors is they are very reluctant to buy country funds. So even if they want to buy, they want to look for Asia funds, and they want to look broad-based, you know, investing styles. So they don't really look at country allocation, which is now increasingly high risk for multiple reasons. One is the economies are not very strong. Second of all, the currencies are very volatile, and they've become extremely volatile in these kind of conditions. And in the process, the allocation for country-dedicated funds is increasingly minimal. And so the global backdrop, as it appears that the appetite for a single country fund is very low, and partly because of their own doing, and partly because the dollar is obviously a better hideout.
So in 2016, we hardly got any money into the country in terms of dollar flows, FII flows. Do you think 2017 will be more of the same?
My sense is we get allocation into Asia funds, and Asia funds then allocate into India. And we've seen some flows. We have been on the lucky side where we've seen very strong flows this year in 2016. 17, we have got early signals that we will get more money which will get allocated to India stroke Asia. But that doesn't mean much. It's like India is a very large market, and you need lots of money and lots of interest to kind of provoke a larger allocation. India is also not very cheap, which makes it more difficult for India to receive any money at all. And in the backdrop that you can see with the other emerging markets, India is the most expensive market, and it's pricing in a lot of growth, which is obviously very elusive.
You are using the word expensive after a fairly significant correction in stock prices. I mean, and maybe not at the level of the index yet, but you know, after this demonetization thing, a lot of consumer-facing franchises, etc., have corrected, but not significantly enough yet, in your book?
No, I don't think so. You know, there are multiple issues here. First is India is a growth market, and we price in growth, pay multiples, whatever it is. When growth becomes elusive, this market should possibly trade lower, and the effective outcomes could be multiples which are significantly back to the median levels, or maybe one standard deviation cheaper. When I say that the correction which has happened is hardly a correction, if you think about it. We've not seen any growth in the last 2 years. We don't see much growth in the next 2 years. At least for the next 12 to 18 months, there is not too much growth which is being factored in. Consensus numbers are still sitting up there, which will need to be kind of downgraded. If these things happen, you know, the best outcome would be possibly, you know, a flattish market, which is very seriously optimistic.
Wow, you're scaring me. Did you use the phrase, you don't see any growth in the next 2 years? That would be a very scary outcome for the market. You think it's possible that this market will keep on waiting, and for 2 more years into 2019 fiscal, you're not going to see any meaningful growth recovery?
As we stand on this perch, answer is yes. But I think for the next 12 months, you know, 5 or 6% growth is not meaningful growth. That's not the price that you pay when the markets are trading at these valuations. When you're thinking about next 12 months and then thinking beyond, rolling it over for the 24 months, you know, on the back of a couple of years of flat growth, if you get about 15, 17% growth, it is going to be reasonable, but it's not going to be spectacular. And you wouldn't pay a premium, right? I mean, which is going to be very difficult to justify.
Time for a break. We return with Outlook 2017 in just a minute.